Welcome back to Yahoo Finance's coverage here at the Milken Conference in California. Lots of focus in these halls on the outlook for interest rates and the economy. Joining me now is a very special guest, Apollo Global Management CEO Marc Rowan. Good to see you again.
Thank you. Thanks for having me.
Appreciate it. So within the businesses that Apollo owns, what have you seen, or what has the impact been from higher for longer interest rates?
Very little.
Very little.
Very little. The way I go through it is you think about what's happening in the economy and what's happening in the US. 3 years ago, we decided to build infrastructure. There's no infrastructure opened. 2 years, semiconductor plants, no semiconductor plants opened. A year ago, Inflation Reduction Act, none of those plants opened. We've been reshoring our supply chain. US has been the largest recipient of foreign direct investment last 3 years in a row. Something tells me we're ramping defense production. All of those things are stimulative to employment. And it does not surprise me. Everyone who wants a job has a job, which means it's very hard to dent the economy. Maybe financial markets, yes, but the underlying economy is strong.
So soft landing achieved, do you think?
I think we've had a soft landing. When rates have gone up 400 basis points and the wheels haven't come off the bus, as they say, I think that's the definition of a soft landing. Will it continue? I think so.
Do high interest rates do they matter to a business like Apollo?
Look, interest rates, the level of interest rates always matter. I'd say it matters almost in reverse. I think investors kind of deceived themselves that they were good investors for the past decade, rather than riding an era of very low interest rates. I mean, look at what's happened in real estate, look at what's happened in other interest-sensitive investments. You thought you were the best investor in the world. You moved to Austin, Texas. You bought all multifamily. It was going great.
Yeah.
The changing cap rate has halved your investment. And now your 3.5% mortgage is being refinanced at 7.5%. You did everything right. You just didn't watch what was happening to interest rates.
I'm an avid listener of your earnings call, Marc, so I will go back to the recent one. And you talked a little bit about investors being levered to NVIDIA, Apple, and Amazon. What do you think the impact to markets have been because of that, being levered to those stocks?
Look, we are in a liquidity-driven, an interest rate-driven, a sentiment-driven market. And sometimes I ask, particularly academics, do we even have price discovery anymore in US markets? It's not clear, especially when you look at what a hard time active management of equities. Here are people who have spent their whole lives becoming good investors, and they as an industry have failed to beat the market 93% of the time for 20 years. Did these people get stupider? No. But did the structure of markets change so that we have positive reinforcement of cyclical flows into index funds and other forms of passive investing? I think we have fundamental changes in market structure that we have not dealt with as a society yet.
So to the investors that are, look, I see it on Yahoo Finance, they love these stocks, they love these companies. What's your advice to them? Is now the time to rethink how you invest?
So look, I'm not in the stock picking business, but very few people come in every day and try to buy 45 or 50 PE stocks. It's just not what we do. I look at the broader trend. We used to have 8,000 public companies. We now have 4,000 public companies. People think most of the action is in public markets. 80% of companies over 100 million of revenue and 80% of employment is in private companies. How do investors have exposure to private companies? Well, the answer is they don't. Institutional investors have it through a product, private equity. But most investors don't have any exposure to private markets. We are just, as an investment world, dipping our toe into private credit. So if you think of the two big buckets that investors have, debt and equity, debt is going first. In debt, there are things like rating agencies that tell investors the level of quality between public and the level of quality between private. And if investors can earn higher returns and have better diversification in private markets, or by adding private markets to a public portfolio, they'll do that. It'll take time in equity, but I joke that they may not own private equity in funds, but they will own equity that is private. And it's our job as an industry to create products that allow investors to come into this marketplace to get the benefits of higher returns and diversification.
I can't think of really anyone that could speak to this better than you, Marc. Are we in a retirement crisis, and then how do we get out of something like this?
Look, we are worldwide. It's not just we in the US. Everywhere in the world, we have, Western world at least, we have aging populations, we have governments who are doing less, and we've had an era of very low interest rates. For the most part, people have not saved appropriately for retirement. How do we get out of it? Slowly. There's no magic bullet. You look at places around the world where they've done an amazing job. Take Australia, superannuation funds. What's been the secret? Well, the secret in part has been forced savings on an annual basis, matching from employers. But a big part of the return, superannuation, the design of it was to give public investors access to private markets under professional supervision. Contrast that to what we're doing in the US. We have between 12 and $13 trillion in 401k plans. What are these people invested in?
They don't know.
Well, I'll tell you, on the whole, they're invested in daily liquid mutual funds and ETFs for 50 years. Why are they daily liquid for 50 years? I don't know. We haven't thought about it in a really long time. Giving people access to the totality of a marketplace, public and private markets, I do think is heading our way. I think for our industry, not just for Apollo, this is a very bullish thing. We have built a whole industry out of a very small bucket called alternatives. We are branching out now and taking over pieces of the fixed income bucket of our large investors, particularly the investment grade private credit bucket. It will not surprise me on the horizon to also think about equity across public and private markets, and not just in private equity fund format.
In the couple minutes that we have left, Mark, I have two final topics. You were really one of the first leaders to speak out on anti-Semitism at college campuses, and since then things have really hit another level. I think USC campuses are closed today. What's your take or read on the current situation, and ultimately, what's the end game of this?
Look, it's hard to give you the end game, but I say very tongue-in-cheek, unfortunately, the fight against anti-Semitism is a growth industry. And that's what we're seeing right now. The protests we're seeing on college campuses, are they anti-Semitic? They are absolutely anti-Semitic. Are they anti-American? They are anti-American. They're actually anti-Western. We're thought of as these protests are leftists. I used to think of the left as liberal. Now the left is illiberal. Where is this going? I think the vast majority of professors at these universities, the vast majority of students, the vast majority of people in this country totally get that there is a way and a right to protest. People should have free speech, people should protest, but there is also a way to take over, to cause damage, to threaten, and to intimidate. And this is a failure of leadership. You look at places like University of Florida, University of Texas, and Vanderbilt, where the leader came out and said, free speech, yes. Right to protest, yes. Time and place, appropriate. They don't have the problems that you have on other campuses where the leader was somewhat ill-defined in terms of the rights. And the notion that we've been catering to a small group of people who hold extremist views, they're entitled to those extremist views. What they're not entitled to is to impose their will on the rest. So I do think we're getting a little bit of a snapback here where people are just tired of it.
Well, I know a lot of people appreciate you speaking out on this, Mark. And last but not least, and look, I understand you can't talk a lot about any potential bid for Paramount, I get it. But where does Apollo see value in an asset like that? Can you help us understand the thinking behind it?
Look, we are a purchase price matters, value-oriented firm, and the way value is created today is usually in places that are undergoing substantial change. So media as an industry, I don't have to tell you, sitting in Yahoo, that media is undergoing substantial change. The notion that you could come in and build on a great business and try to navigate through these turbulent times, I think is where we create value. We historically have been long investors in media. We've done it across almost every sector in media. Obviously right now we are invested in Yahoo. We are also invested in Legendary. And by bringing along a respected industry partner, Sony, I think we look at this as just an interesting opportunity to create value in an industry undergoing change.
We will leave it there. Thank you for always giving Yahoo and Yahoo Finance time. Marc Rowan, CEO of Apollo Global Management. Good to see you again. We appreciate it.
Total pleasure. Thanks.